All right. Good morning, everyone. Thank you so much for joining our first session today on our retirement plans and socially responsible investing engagement webinar. My name is Manjulika Das. I am the membership and marketing coordinator for SBN. And we're so pleased to welcome our fantastic panelists who will speak to the small business owner on how to navigate retirement plans and investing in what has been a very transitional and uncertain period. So we'll start off with some very brief introductions of our panelists and have them elaborate a little bit more on themselves once we get into the presentations. So I'll start off with John Gregorio. He is an independent, credentialed, and experienced advisor of Capital Management Partners who works with small business owners. We have Rob Thomas, who is the president of his company Social K that he founded in 2005 to offer ESG options for mission-based organizations. We have Clarice Avery, the investment strategist for options-based low volatility equity strategies and sustainable and ESG investing at Natixis Investment Managers. And we're so pleased to welcome guest speakers from Pentegra Retirement Services, Zach Demers and April Horn. Zach Demers has accumulated 15 years of retirement plan experience with a specific focus on 401ks or 403bs, and he's led Northeast business development at Pentegra for 5 years. April Horn is the relationship manager at Pentegra, and she has been in the industry since 2002. She is a Spanish-English bilingual, which is an invaluable asset when working with Spanish-speaking clients. So before we get started, just some simple housekeeping rules. Please feel free to utilize the Q&A function to ask questions. We will be holding time at the end to answer these questions. In the meantime, if you want to make any comments as well, if you want to chat with us, feel free to use the chat box below, below your screen. This session is being recorded, so if you are unable to join us for the full hour, feel free to send us an email or check out our website where we will be making the video available for viewing, most probably this week. We will also be having another session with the same content presented at 2 p.m. today. So with that, I would like to turn it over briefly to Lori Hamill, who is the Executive Director of SBN.
Hi, everybody, welcome. And we're thrilled to have our participants join this session. And we at the Sustainable Business Network of Massachusetts feel very blessed to have so many companies and leaders in the finance community who are committed to what is often used, the term ESG, which is environmental, social, and governance concerns and values. And SBN was founded 33 years ago and around all the ideas of trying to create an economy that is local, green, and fair. And we feel this finance panel and conversation is very important because we want to encourage two things, of course. One is that when people do have money to invest, we want to make sure that the money is going into places and to businesses that are doing good stuff as well as making a profit. And so that there's an emphasis on ESG and socially responsible investing. And the second half is, of course, is that we're all about trying to help people who are do have some money and that are, you know, even if it's the money's not that much, if they do have money through their 401ks or other mechanisms, that we would like those to be able to increase their wealth. Because there are a lot of people in this country who do have money to invest and aren't necessarily increasing their wealth. And so we also want to make that happen while we're doing good at the same time. So we're very fortunate to have representatives of these four companies, and we're thrilled to have you. So thank you very much. And Manjulika, thanks for organizing this. You've done great. So I'm looking forward to our time together.
All right, thank you so much, Lori. We will get right into the presentations. And all right. So John, the floor is yours.
Well, thank you. Good to see everybody. And I think I just wanted to tell you a little bit about Capital Management Partners and myself and how we kind of fit into this workshop. We are specialists that work in retirement planning. So when we're meeting with that business owner, we're really partnering them throughout the whole process, making sure that they understand it from the beginning all the way through implementation and monitoring. And I think there's probably four areas that they're looking, business owners looking at us to help them with. One being that expert guidance. And for us, it's really about giving them that opportunity to do the work that they do. So we're kind of an extension of their HR department, really to help simplify and manage that plan. So it just, again, gives that business owner more time to focus on other aspects of their business. The second piece is a term called fiduciary. So it really allows us to give that business owner a disciplined process. And that'll really ensure that that retirement plan, whichever one that they choose, is operating kind of with the latest fiduciary guidelines. And that word we'll talk about throughout this workshop, but it really gives you confidence to know that we're serving your best interests at all times, as well as your employees. The third piece, investment support, which Lori had mentioned, and we'll go into a little bit more detail, but really help to hopefully draft an effective, what's called investment policy statement, to help offer you and your employees that kind of suitable range of products or investments that are inside of that retirement plan. So that's the third. And then the fourth, which I think is really important, is once you kind of make that leap and that decision to say, you know what, I want to have that retirement plan, can we then work with your employees and make sure that they're educated? They feel empowered to know that they can make their retirement choices that'll help them in the future. So that's that fourth piece that'll really help kind of allow them to know the value of that retirement plan. As Lori had mentioned, it's a lot of what we'll talk about is aligning people's passion with hopefully getting some performance in their underlying investments. And some areas will resonate more than others. Some of the speakers that you'll hear from Rob and Clarice, they'll talk about the different themes that are out there for those underlying investments. And again, some may affect people in other ways. So it's really important for us to know which one is going to be effective for you and your employees. So let's go to the next slide if we can. So when we talk about our goal, actually the one previous, if I can. Yep. So the goal there, again, helping that business owner managing those risks and ensuring they're making informed decisions. The piece here that I want to talk about is seeking to maximize fiduciary protection. Again, from that business owner, once they make that wonderful hard choice of saying we want to put that retirement plan in place, let us kind of do a lot of that due diligence on the back end to making sure that it works for you effectively, but also is in compliance as it moves forward. We're going to talk a little more on the enhanced investment opportunities that'll really help in this day and age, much more top of mind, right? Social objectives. That third piece, managing plan costs, it's important, right? We want to monitor and make sure that those fees and services are reasonable. You're a business owner, chief cook and bottle washer, right? So you have to make sure that you're looking at all the costs and fees associated with it to make sure that fourth piece, that you're really having an efficient plan. And again, I think it's effective for the business owner, but we're going to talk a little bit about how this is really important for an employee. And that's that third piece where it has the integration for that education planning. Yeah, and that's that last piece. Just making sure that the employee education is really front and center, so that way they know that this plan is available to them and the importance of it. So we can go to the next slide now. So told you a little about kind of what we believe and now how do we work again with that business owner. We serve as a 321 co-fiduciary. Again, we're going to talk a little bit technical terms here, but I'm going to let some other speakers talk more about that as well. But as we meet with business owners, you'll see what we mean by that. Again, that seamless experience for you as an employer and your employees is really important. And we kind of view ourselves as a guide, right? So again, once you make that decision about that retirement plan, making sure that it's put in properly. What I like about this slide, though, is the visual, right? On that right-hand side, you'll see you as the employer in the middle, and a lot of different people who are trying to either contact you and work with you. So we kind of consider ourselves a buffer, right? Trying to insulate you to make sure, again, that you can focus on your business and making sure it keeps on moving forward. So you'll see us try to create that barrier for you on those other people that are, asking for your attention as you move forward. So we can go to the next slide. So this is a very informative slide, a lot of information there, right? So I certainly don't want to go into too much detail. This kind of highlights 3 of the plans that we've seen a lot of business owners use. But again, some it may not fit what you're trying to accomplish. Some of the highlighted parts there, you'll see some dollar amounts. Now, Lori had mentioned in the beginning, right? Some people can save a lot, some people can't save very much. What's the mix, right? If a business owner wants to save maybe 19 or over, close to $20,000, there's options for that. But it's really important for you to know, again, as that business owner, if you have an employee who can only put in $25, $50 a month, that's okay. That's something that is important for us to know when we're designing that plan, to make sure that that employee feels empowered to know that they, even though they're starting out at a small amount, that can increase over time. And even the plan itself, you might start with a plan that is more geared for a startup, and then it morphs into a different retirement plan. So again, when you're in that decision process, know that we're there with you. It's not as though we're just giving you that plan and kind of walking away, and that's the only thing that you can have. The underlying piece, again, you'll see the SRI and ESG investments. Boy, this is it's a really powerful theme about just integrating and aligning your investments with your passion. And this, what we're seeing more and more, especially with SBN, but also even people out there in the world as well, looking at their retirement accounts, looking at their retirement plans, and saying, can we make a difference with this money as well? And the answer is yes. It really is. So again, the next speakers will go into a little bit more detail, some of the numbers aspect, some of the performance aspect of it. But just again, know as a business owner that this is available to you, and that we're hearing it also from the employees as well, that they want to make sure that this is available to them. So we'll have the next slide. This I thought was very timely because of the fine print there in the bottom. This was a survey taken actually back in March 10th through March 30th, 31st of this year. And no one, I think, really wants to look back at that time. It was a very, very difficult time. Not that now is not, but the markets were gyrating. That was really a real difficult time during this pandemic. So I think a lot of this rings true. So we'll go through some of these statistics. And again, from an employer standpoint, knowing what your employees are looking for to better attract and retain those employees is very important, especially as we kind of get through the pandemic and as you build your business moving forward. So 9 in 10 think retirement plans is one of the most important benefits of having it at work, right? They feel as though they want to make sure that they're preparing themselves for retirement. That middle part, 70% believe automatic enrollment should be implemented. That just means, again, once they're kind of onboarded as your employee, boy, let's start that retirement plan right away and make sure that they're starting to save, they're saying, at a 6% contribution rate. Nearly 8 in 10 want at least a slight nudge of encouragement. Again, so this is where you as an employer, as you're onboarding that employee and saying, okay, great, we have a retirement plan, call John. He can really help you do that and make sure that you're doing it the right way. taking that kind of HR piece away from you so you can focus on what you do best there. That bottom left, 3 and 4 participants would find it attractive if employers offered holistic financial advice. I think that rings true, right? Especially in today's world. A lot of people want to make sure that there is kind of a broad brush of what their financial picture looks like. But look at that bottom piece, 6 and 10. I think it's low. I think if we were to poll some of the SBN members or people nowadays, now that we're kind of somewhat hopefully getting towards the end of the pandemic, the 6 and 10 express interest in ESG investments as part of their retirement plan. I bet it's probably 10 to 10, maybe for SBN members. Again, that's what employees are looking for is yes, it's great to have a retirement plan, but can my investments also make an impact in the world? And that's kind of that last piece. Nearly 3/4 believe that sponsors should default participants in target date funds. Natixis is going to go over a little bit about that. And that, rather than forget it, theme where that employee gets onboarded and says, you know what, I'm retire in 20 or so years or at age 65. So that investment is kind of positioned for that. I'm not going to go into too much detail, but again, it's something that is available in some of the plans that we're talking about. Again, alleviating that pressure of the employer or the employee really figuring out kind of that underlying investment. The next piece we thought was good to put there about how to retain and attract employees. But I think what's also important is to ask either the employer or the employee, it's really important for me to understand their view of investments. And there's generally kind of 3 areas it'll fall in. 1, they'll be concerned about performance. 2, they actually only just want to make sure that their investment has impact. And then there's the third one where you try to kind of meet in the middle, wanting to make sure you have performance, but also making an impact as well. And where do you fall? Where do you fall in that spectrum when you're asked that question? Each person is going to have a different potential answer, as well as the employee might have a different answer as well. So that next slide, Matt, you look at how to retain and attract employees. I thought this was important to put in there again. The idea as a business owner, you have a lot of things that you have to worry about, but are there things that you can put in place that employees are looking for or seeing as important? And you'll see again, 93% think a 401k or some kind of retirement plan is important to have in there. What I thought was interesting in that piece is the bottom one, 11% offering 529 plans. 529 plans are in its simplicity, is a way to save for higher education, colleges. We do see that creeping up a little bit more, having that kind of potential option available for employers. And again, if we're talking about topics that have interest, just jot them down and we can talk to you individually about those. The wellness benefits, well, now that we're kind of out of office, they may not be as important. The quiet rooms and fitness activities and standing desks certainly seem to be important when we were going back to the office. The family leave and flexible working benefits. I think the increased engagement and positive employer brand are really becoming more and more kind of impactful for those employees. Is the company I'm working for making a difference either in their product or in their profits? Are they trying to do that? And that's that positive feeling that the employer brand has that could help attract employees with a like mind. And again, once those employees feel as though that they found a place that they believe in, that retention level really increases dramatically, which leads to that last one, the programs and services, that professional and career development. Again, if I'm going to a company, are they willing to potentially invest in me to better myself, either through online education or some kind of promotion to make me feel as though they want to better myself and invest in me as a person. We'll go to the next slide. So this I thought was important to have on there because outside of, retirement plans in particular, are there resources, are there things available to you as a small business owner? And the answer is yes. It was great. Manjulika and Lori, we approached them early on. That second one, the COVID-19 updates and resources. This was a hyperlink that you're welcome to visit, and it has a lot of articles, a lot of information on the legislation this year in 2020, as well as how it can affect you as a business owner. So it's a great piece to know that it's updated regularly as well for you as a member. So feel free to use that and forward that to as many people as you'd like. I think in conclusion, a lot of what you'll hear about today is we're here for you to help guide you through the selection of retirement plans and the cost and the investments that are underlying them. Whether you're just starting out, whether your business has been in, for a couple of years, or whether you're a mature business, we'll kind of meet you where you are. You may have a retirement plan in place and you haven't revisited it, and you haven't really looked at how are those investments aligned with your particular mission. That's okay. That's what we're here for as well. So that, we can look at your current plan as well to see if it fits what you want to have, what you want to have done. So I've told you a little bit about kind of what we believe in, how we do it. What we're going to go through now as a panel is some of those underlying themes about ESG and SRI investments, and I'll be here obviously throughout as well. But thank you all for attending, and we'll have the next speaker.
Thank you so much, John. Yes, we really did appreciate John, approaching us with, these very helpful resources for our members and our network at the start of the pandemic. So feel free to check out those links. We will also be following up in an email after this session with those links. And with that, I will hand it off to Rob.
Thank you, Malika. So Social K started in 2005. I've been in the business since the last century. The tech bust came in March 2000, and I had to figure out something else. There was a strong group in our office that did 401k and ERISA plans, and I started working with them, realized there was no SRI option, socially responsible investment option, that was the term back then, in 401k plans. So I put together a program that offered Calvert funds, load waived A shares for plans under $1 million, and was a huge success. Went back to my business, where I worked, UBS, and said, we got a pretty hot product using Calvert, let's expand it, we'll call it Social K, we'll add other green funds to it, and we'll go sell this to business owners across the country through the UBS offices, to businesses that have a social and sustainable mission statement. There was a pause, they laughed, they said, you're so crazy that you can go do that on your own while you still work here, because we just think there's no value in that at all. So I created Social K, and then was able to retire from there in 2009, took Social K with me, and been doing it ever since. And work really is with people like John, with plan participants, with mutual fund partners, with the record keepers, to bring together a consistently cutting edge product that offers environmental, social, and governance screened funds for 401k, 403b employees. How's that? Next slide, please. So we're here about moving your money, right? Your money is either just in your bank account, and you need to put a plan into place. And this goes for you as an IRA, as well as you as a business owner. At some point, you either got going or you need to get going. You may be doing some green investing, but if you're not, now's the time to move your money. And we're going to go through the way to do that in the 401k world, but a lot of what you're going to hear today can be applied to IRAs as well. Next slide. So it's not really a hard concept, it's a hard language. The language that we use is language that a lot of people, we forget that you don't understand what we're saying, right? But at the end of the day, what we're doing is not hard. Now in this case, this is the principles of retirement of responsible investment. Principles of Responsible Investment, did a paper back about a year ago, and they studied what it was for ESG, specifically in the 401k world, where the plan sponsor, the company, is a fiduciary. A fiduciary is someone who is responsible for someone else's money. When you're responsible for someone else's money, you have to work at a higher standard. And what they're saying here, very clear, that ESG screens alongside financial screens, right? The mutual fund manager who's trying to decide whether he's going to buy Apple or not has to look at the finances. Can Apple continue to do what they're doing? They want to look at the environmental footprint and want to see if there's any risk hidden in the business practices. They want to look at the social practices. How do they treat their employees? How do they treat their stakeholders? How do they treat their neighbors? And are there any hidden risks in that area? And finally, the governance of the company. Who's the board of directors? Are they independent? Or do they all belong to the same country club as the CEO? Understanding those things are just as important as understanding the finances of a company. And so it's no longer marginal to have ESG screens. It's mandatory. It's no longer optional. It's an obligation as a fiduciary and as an individual. Why wouldn't you add additional criteria that helps lower risk? Why wouldn't you do that? You listen to the Department of Labor and they believe it puts an undue burden on the company, but that's a whole nother argument. And Zach will go into why you may want to use a 316, someone to take all that responsibility off your shoulder if you are worried about the Department of Labor looking at your environmental, social, and governance screens. There's a lot of ways to build a product that works easily by using the team or team members of what we've assembled today. Right, so go ahead to the next slide. Today you're going to learn a lot about how to do this, but if you forget any of it, and at best you'll remember 10%, and if any of you remember 10% of today, I'll be proud of you. No offense to the speakers, it's the subject matter is a little dry, right? But here's a guide that Green America, previously Co-op America, a client of Social K, and Social K put together, kind of a step-by-step how to get going at your company, whether you have a plan or not, how to get enough people, how to get enough people motivated, how to get the message up the chain, and how to make change. Whether it's adding a plan with ESG or modifying an existing plan, we can help you figure that out. So those are two giveaways that we've got for you, the Principles of Responsible Investment piece and this guide. And I'm going to wrap up. After me, you're going to hear from Natixis, Clarice, and she's going to talk about exactly what that environmental, social, and governance means when you're a mutual fund manager, as Natixis is. And then Zach's going to talk about how to go ahead and put a plan in and reduce some of that liability that I talked about, and not, hanging yourself out to dry by being the person responsible to sign the 5500. And unless anyone has any questions for me, I'm going to pass it on.
Great. Thanks, Rob.
Yeah.
There we go. We can start right here. So I won't go into depth on myself because it's not about me today. And Manjuka already introduced me. So I'll do a little bit of an introduction on who Natixis is and what that means for you. And then I'll kind of cover what we'll talk about over the next few slides. So Natixis is a global asset management firm, which Rob touched on. And our structure is a little unique in that we've gone out and bought all of these different asset management firms, these very unique and differentiated investment managers that have expertise in different asset class, different investment styles, and so on. And what that means is that at Natixis, we're able to bring together all these different managers that have different philosophies on investing, different resources, different investment processes to build a really well-diversified, what we call the target date fund, a multi-asset class, multi-manager, well-diversified target date fund that can act as that kind of go-to default investment option in your retirement plan. And we have a product called the Natixis Sustainable Future Funds, in which we've done that. And the unique part of that fund, those funds, is that it's ESG driven. That kind of comes through in the name, but it's really about selecting investment managers to manage those underlying assets that are really focused on incorporating those environmental, social, and governance considerations within their investment processes, really in an effort to drive better financial outcomes for participants. So to achieve a better risk-return trade-off. And at the end of the day, we think you're able to also achieve this better, what we would call sustainability profile, or a little bit more sort of positive environmental and social impact relative to a traditional target date fund or the traditional market. And at Natixis, we're very open to, helping you and working with your participants around education on this. We do a lot of participant and employer education on this topic. And, some of the slides that you'll see today, you would see it in presentations like that. This, of course, is only scratching the surface, but just want to throw that out there that we're very willing to do that type of education for you. So in the next few slides, I just want to talk about 3 considerations that you might want to take into account when thinking about considering ESG investing options in your retirement plans or personally. And this just builds a little bit on sort of what John and Rob have already covered. So one is, the economic impact that material ESG factors can have on investment performance. The second is the potential plan health implications of ESG. And then lastly, we'll touch on the shifting sort of employee or participant demographics and how that's connected to ESG. I think I'm going to focus mostly on that first part, given I am coming from the investment management side. So I'll focus on the financial or investment performance related implications of ESG and how ESG analysis and ESG factors helps asset managers like ours to better manage investment risk and identify growth opportunities. And of course, that's very important from the perspective of the fiduciary standard. So just staying on this slide, what is ESG? I'm not going to go into too much depth here, but ESG has certainly become sort of a catch-all term for investment products that focus on environmental, social, and governance factors when making investment decisions, and that comes through in a lot of different ways. But ESG is much more than a product label. So I think it's important to think about what ESG is and what it can help different investors achieve. And this, of course, is going to depend on the goals of the particular investor or asset manager. And there's really no blanket approach to how investors are using this ESG information. So rather than thinking of ESG as that product label, we want to think about it as raw input. So raw information about a business's products and practices around environmental and social and governance dimensions, that we can incorporate into our investment analysis. On the next slide. So this is sort of our framework for how we think about what ESG information can help us to assess in the investment process. And it's somewhat multidimensional, as you can see. So we view ESG information and analysis really as being really important for 3 main reasons. When it comes to investment decision making. So one, starting at the bottom of this pyramid, it's really foundational, it's risk management. So here, we can leverage our analysis of ESG information about companies to identify potential investment risks, such as companies that are maybe industry laggards in managing their key ESG related risks, whether they're environmental or social or a combination of both. And so these companies that are laggards might face, reputational damage. They might face litigation or regulatory risk as a result. And we can also identify companies or types of businesses that won't even survive long-term, either because they aren't willing to or can't adapt to the way the world is changing. So these are the types of risks we want to avoid in our portfolios and in our retirement plans. The second is, it's all about identifying opportunities and capturing growth opportunities. So we can use ESG information to identify companies that might have innovative practices around, waste management, water management, even, internal social and labor and employee practices, which could ultimately lead to cost reduction for that company. Or it could be companies that are solutions providers that have significant growth opportunities, say as a result of the transition away from a fossil fuel-based economy. So we would think about wind turbine manufacturers, for example. Lastly, ESG can, it can help us to identify the business models of tomorrow and what we think a sustainable economy looks like. And then we can start to create, better environmental and social outcomes and create that value that ultimately we think translates into economic value over time. And so this is just really an added benefit of many ESG strategies. So, overall, this type of analysis really just allows us to have a more comprehensive view of the types of risks and opportunities that a given company that we're looking at might face going forward. So that ultimately for us is going to lead to hopefully better investment decisions. And what that means, again, for you and for your participants is, again, hopefully better financial outcomes, but also that, better sustainability outcomes relative to traditional investments. On the next slide, why does ESG matter even more today? So if you look at, this is the World Economic Forum's annual survey of world and business leaders on what they think are the major risks to economic development and growth going forward. And what this shows is it shows environmental risks in green, dominating this list both in terms of likelihood and impact for basically the fourth year in a row. So now it's risks like our collective failure to act on climate change, biodiversity loss, and natural disasters that world and business leaders are really thinking about. And so we know that, as investors that focus on sustainability, we know that sustainability analysis has always been important. But these risks continue to intensify and persist. They transcend economic cycles, but we see the market and many investors and analysts today continuing to underestimate the risks and the growth opportunities that are associated with these trends. So we think it's even more important to consider these factors. On the next slide, the shift away from what we call, tangible assets in terms of how market value, equity market value is comprised. So the shift away from tangible assets and toward intangibles is also increasing the importance of good ESG practices by companies and also ESG risk management by investors. So this chart is showing, again, that changing composition of S&P 500, just using, the most well-known equity market index. So the changing composition of S&P 500 market value, where now you can see that nearly, and this is as of 2015, but we can, we know that proportion of intangible assets is probably going to increase if we look at this more recently. But it's basically all comprised of intangible assets. So intangible assets or intangible value is things like people, intellectual property, a company's brand, image, and reputation. It's things that can take a company years to build up and get good at. But it's value that can be destroyed very quickly today and not easily replaced, like many tangible or physical assets such as buildings and equipment. So this is why it's really important for companies to consider their environmental footprint, how they handle, employee relations, how they handle relations with their suppliers and customers in the communities that they operate in. On the next slide, of course, last but not least, in terms of why ESG matters, we think even more today, is that it matters to investors like your employees and yourselves. So we at Natixis survey different groups of investors on a yearly basis, and they tell us that they want to invest more sustainably and do that within their retirement plans as well, and that they believe that ESG factors are relevant to investment performance and risk outcomes. So here you can see about 70%, bottom left, about 70% of individual investors believe it's important to make a positive social impact through their investments. 60% bottom right, want to see more of these investment options available within their retirement plan. We don't have the stat here, but we also have a stat that says that a majority of people surveyed also said that they would consider contributing to their retirement plan for the first time or contributing more if they had these ESG options available to them. And, you know, as John sort of touched on, right, we think these percentages are probably a little bit lower than reality, especially when you're thinking about a network like the SBN. But it's also about education too, right? There's maybe a lack of education around ESG investing, and people just don't know that it's an option for them. And these results really are across demographics. So it's, you know, we're not just looking at millennials and Gen Z, but when we do, you know, these numbers actually tick up a little bit because these, you know, big issues like climate change, you know, and diversity, equity, inclusion, which are of course very important to all of us on today, but we know those are top of mind for the younger generations. So we might want to think about, you know, what's important to our changing workforce. What are the types of benefits that might appeal to them? So this is where we start to think about, you know, the plan health implications and even what it could mean for your business as a, you know, a recruiting and employee retention tool. So, you know, again, we think with the right type of education for participants, they start to feel a little bit more connected to these types of investments and are probably a little bit more engaged than they otherwise might be. Maybe that leads to, you know, increased participation and contribution rates. On the next slide, and very important, we want to talk about what actual performance has looked like of these strategies. And we're just showing a simple comparison of a traditional global stock market index in the purple, the MSCI world, and it's the ESG version, the ESG focus version of that same index. What it shows is that the ESG focus index has actually outperformed the traditional or non-ESG focus index historically, and has actually produced on the right-hand side better risk-adjusted performance over time as well. So and if we look at actively managed, you know, mutual funds as well, we actually see similar results and maybe even more of a performance differential to the positive because of the fact that, you know, there's more ESG risk management. We have a broader view of the risks and opportunities these companies face, and we're better able to manage that. So again, it's not to say that all ESG strategies will outperform over every time period, but it's to say that there's not necessarily a performance trade-off, as there's been this, you know, negative connotation historically that there is, but rather, again, ESG might better help us manage that broader set of risks and capitalize on different opportunities. So last slide, really just to summarize again, you know, why we think ESG investing makes sense in retirement plans today. It's the shifting demographics of your employees. It's, you know, the plan health considerations, and then, you know, most important is the economic interests and financial outcomes for your participants. So, you know, while it is about, you know, aligning with your purpose, right? You can maybe, you know, really demonstrate your commitment to sustainability issues. But it doesn't always have to be about that sort of values alignment, because a lot of people might not want that out of these investments. So you can sort of get the best of both worlds, where you have strategies that we think can perform well over time, but you can have that nice benefit of better sustainability, better values related outcomes. So with that, I'll hand it off.
Thank you so much, Clarice. We will move on to Zach and April from Pentegra.
Thank you. Well, everyone just covered a lot of the ESG components. Rob and John specifically mentioned the components around the fiduciary standards that come with 401k. Specifically, I'm going to be talking about 401ks as the pinnacle for retirement plans, most commonly used in the nation. And the responsibilities that come with that, and the importance of 316. What is 316, right? Even in the presentation itself, the importance of 316, but what is 316? I'm going to be kicking this off. I'm in partnership with my friend and colleague, April Horn, who's a relationship manager here at Pentegra, and we kind of just divvy up the slide. So you'll hear us kind of toggle back and forth. Next slide. So first off, who's Pentegra? Why are we talking about this? So Pentegra has been in business since 1943, long time, right? We're much more than a typical TPA or record keeper. We do, as you think of a third-party administrator that handles the administration for a retirement plan, a 401k, oftentimes called a TPA, and the record-keeping technology of that 401k. That's what we do, just so you know who is kind of Pentegra. Today, we're one of the largest and oldest experienced fiduciary administrators for 401ks or 403bs across the United States. We were actually founded as a nonprofit for the Federal Home Loan Bank. That is actually still in existence today, that plan. So I like to think of us as a building that's been in business for now 77 years. And outside of that building, we've been waving this 316 flag that I'm about ready to get into since 1974, which is actually the first year that ERISA, which is the law, ERISA is a law that essentially creates the regulations for defined contribution plans, AKA 401ks. Next slide. So what the 401k surveys oftentimes show why they have the 401k. It's the pinnacle of a retirement plan everyone essentially wants, but there's certain considerations when you go into having a 401k. There's the risk that comes with having a 401k. The 401k is regulated again by ERISA law and the Department of Labor. There's the cost. 401ks aren't run by the Salvation Army. There's a cost to them. The servicing of the 401k, that sort of thing comes into John's category. The workload, because you have a 401k, there's things you need to do now that you are offering a 401k to your participants or employers. The investments, which everyone really has just focused on prior to me, the investments, but obviously we're specifically focusing on ESG and SRI, and the education of that, the education to your valued participants, education enrollment meetings, going into the 401ks, think of things like that. Next slide. What April and I are going to be focused on specifically, though, is these two considerations. The other four considerations are really what would be really with John or Rob and the aforementioned comments that Clarice put in as well, the investment side. What I'm specifically focused on is the risk and workload that comes with the 401k and reducing that or mitigating that risk and workload. So risk, right? I'm a business owner and I'm running my business. You can kind of think I have plenty of risk, too much as it is, or workload. I don't even want to think about more work. How can we mitigate that and reduce that as much as possible? What the 316, if you can go to the next slide. 316, this is a little nerdy. I am a 401k nerd, admittedly, self-proclaimed, but what is 316 administrator really? This is it. So this is what the term administrator means, the person specifically designated by the term of the instrument under which the plan is operated. If the administrator is not designated the plan sponsor, blah, 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 right? What's that mean? The 316, according to ERISA regulation, equals plan administrator. The plan administrator, every single 401k has a plan administrator. Literally, the liability for the administration of the plan falls onto the lap of the company. And specifically, there's always a person who is signing off on that. So again, 316 is merely a legal code, if you will, not to get too nerdy, but it equals plan administrator. So each 401k has a plan administrator at the company, and that liability falls on someone's lap who is signing that. In contrast, a term you've probably heard, as I already mentioned, a TPA at the very bottom, or a third party, is not an ERISA term. It is merely a hired contractor performing a clerical function without fiduciary liability. So you can have a third party, again, it kind of explains self-proclaimed, third party administrator doing clerical functions for your 401k plan, and they might respectfully do a great job, but ultimately they are not legally liable for the work they're doing, where that would still fall on whoever the plan administrator is for the plan. Next slide. Thank you. Yeah, pause there. So this is for those who know 401k or haven't gone down that road, each 401k has to file annually this form called the 5500. So it kind of looks like a legal document that would something go to Uncle Sam, to the government. It is. This right on it even says ERISA at the very top. It even says the Act of 1974. As I already mentioned, we've been doing this since that first year. This is a form for the Department of Labor that requires this. And the reason I've circled that red line it says sign here, signature of plan administrator. So this is obviously a sample. These are all public. This is all public information. You can pull these for any company, actually. You can see a signature there that just says John Doe, but it says signature of plan administrator. So what this 5500 is proving to the Department of Labor and why they have you sign this, I kind of jokingly, to make light of this, oftentimes say, why do you think the Department of Labor is having you sign this? You're not a celebrity. They're not collecting autographs, right? The Department of Labor, the government, if you will, is only having you sign this because they need to know who's the liable party for the plan administration fiduciary liability of the underlying 401k in question. So you can see the name of the plan. On this section, you're just a sample employer 401k plan. Section 2A says the plan sponsor's name. But that signature, and it's always someone at the company. It's usually an owner, a trustee, an HR director. But the Department of Labor want to make this real easy for themselves. It's even on the first page. They want to be able to pull this out. What's the name of the company? And if anything happens, who are we going to be at least talking to on the phone or maybe seeing in court? That is that person right there. So whoever's signing that, they are the face, and there's really no other way to put this. They are the face to the Department of Labor. The reality is there a better way to be doing this as you have a 401k to, again, mitigate as much as legally possible that risk and workload that comes with the 401k? This, anyone would essentially argue, is a risk. Because your name is on this document, you are at risk of the Department of Labor contacting you. They're not singling you out. It's because you signed this. Next slide. So think of, this is really, and I've been doing this for 15, 16 years. Two main categories of fiduciary liability. You can think about it. In one hand, you have the plan administration fiduciary liability. In the other hand, you have the investment fiduciary liability. The bullets underneath them could be very similar. So under the administration side, again, that's my company, the time it takes to do that work, the administration of the plan, the expertise, the labor, but very important. On the investment side, this would be something where John Gregorio's side would be on. The research of the funds, the concerning themselves with the constant performance of those, the constant monitoring, but very important. Is there a way to outsource this as much as possible? So again, if you have a 401k, those are the two main categories of fiduciary liability. Plan administration fiduciary liability, investment fiduciary liability, both equally important. One you already saw, if you go to the next slide, John, I already noticed on one of his slides, he even mentioned 321. 321 is another ERISA, a nerdy ERISA code. It essentially means the investment fiduciary liability. So what I've checked off here is both of those. On the left side, you see the 316. I won't go into the 402A. It's other technical, directed trustee, other services Pentegra provides. On the right side, you see the 321. But my point here is it effectively allows a company to wipe their hands of as much fiduciary liability as is legally possible. What we do here at Pentegra is that 5,500 we saw a couple slides ago, that 5,500, we actually take on the liability for signing and filing that. So guess what? Everyone and the listeners probably get where this is going now. Oh, okay, they understand as a business owner, when your name is on a legal document, especially a legal document that's going to Uncle Sam, if you will, or the Department of Labor, that means something. It means something when your name is on it, and it means something when your name comes off of it. We at Pentegra here, we sign and file that 5,500 for you. That is the crutch of this presentation. What is 316? The importance of outsourcing it. Really the demand in the industry is going towards, instead of just having a TPA, a third-party administrator, performing that clerical function for you, but without taking on any real liability, still having the business owner, the HR person, ultimately sign that 5,500 to the Department of Labor saying, hey, I did some work for you. Hopefully I did a good job, but you sign here and you be liable for the work I'm doing. Adult rational thinking would almost dictate, wouldn't it be better if actually you did all the work and even more, but then you actually signed that document that makes you liable for the work you did? That is what you can do these days. You've frankly been able to do that since 1974, but it's still considered kind of cutting edge or almost unorthodox. A lot of companies don't want to take on that liability. They want to keep that in-house to your house. They don't want to take that in onto your house. That's what we're talking about here, is outsourcing that role. As again, it's all about wiping your hands as the business owner of as much fiduciary liability and work as is possible. So again, those two X's are important. The investment side would be going to someone like John Gregorio. The plan administration side would be going to a firm like Pentegra. But the most important thing here to note is that within a 401k, there is a way of having a 401k and saying, that workload and risk, you can really get rid of that as much as legally possible. And by virtue of that, a 316, if a company is acting in that capacity, say Pentegra, we also have to do that much more work that April will touch on as well. But next slide.
Thank you, Zach. I now wanted to explore outsourcing and the administrator role. Why would you want to seek this? You as the employer are currently legally the administrator, and I don't think many really realize what that consists of. But the role can be outsourced to a professional 316 administrator such as Pentegra. But why would you outsource this role? For one, it's safer, it's simpler, it's cost effective, and then you have less work, risk, and liability, which is always nice to kind of put that on another person. Owners and trustees' names come off the plan document, which is where the 316 would come in and the professional signs on. Another item would be the 402A, but that's more on the directive trustee side. But really outsourcing the administrator role to a professional 316 is definitely the route you would want to go. We can go to the next slide. And next again, please. There we go. A few key considerations. So here, I want to start off with 51. 51 separate types of tasks to be completed. This is something that a plan administrator would have to handle. If you were to outsource your plan, you would actually outsource to a person like myself, a relationship manager, who would handle those 51 tasks and really just assist you along the way. It signifies the number of responsibilities a plan administrator has. The 102, 102 hours are spent on average tasks. That is a lot of time. If you put that in more layman's terms, that's about 2.5 weeks of vacation. So we could definitely use that time in other ways and be more efficient with that. 250. If we can hit next one more time. Thank you. The term plan administrator is most commonly used term in the document, 250 times. That is how important the role is. If you're not outsourcing, that's a point of liability to you, the employer. And this is time, risk that we want to save from you. If you can go to the next slide, please. I did mention about the tasks that are spent. These are some of those items: distributions, plan audits. There's mandatory notices that participants must receive every year. There's compliance testing. And then you'll see right there in the top left-hand corner, 5,500s, and that's something that Zach had mentioned earlier. These are just the minimum number of items that a plan administrator can outsource to a 316 to handle. We can go to the next slide. A few more items to note. I did mention mailing items to or notices to employees. That does mean former employees as well. So if you have an employee that's left 10 years ago, but he still has an asset balance in the plan, you are responsible to make sure that participant receives notices and their statement. As a fiduciary, you have to handle that. Reviewing, approving, signing off on all loans, hardships, distributions, and then we have qualified domestic relation orders. That's for those who do, go through a divorce. You are responsible for retaining documents and proof and submitting that to be processed. Making sure your restatement, your plan document, or your Form 5500 is signed in a timely manner. This is your responsibility to handle. Gathering receipts, I had mentioned that earlier. If you do have an employee that goes through a hardship, you are responsible for retaining documents to prove why that employee is eligible for a hardship. And then last and not least, if your plan does have automatic enrollment, it is your responsibility as a 316 to make sure that those employees are automatically enrolled into the plan. Once again, all of these worries, these tasks can be outsourced. It's a great item to definitely venture off and see. If we can go to the next one. I had mentioned earlier on the slide with the 50, this is just more in depth of what that consists of. As you see, it actually looks like the list is getting a little bit larger as I'm speaking here. But I really just want to touch on the time it takes for each item. You're juggling 50 plus items, it's different, it's time consuming. The reality of the work is that you're liable for this, right? As a company, as the plan administrator, you're liable for this to make sure that it's handled in a timely manner and that you do keep records of this. And so I just wanted to reiterate why it is a good reason and thought process of outsourcing to a 316 administrator.
Thank you. So here I'm a true New Englander and a Red Sox fan. For better or for worse, some years it's good, some years it's bad. I made this slide a couple of years ago. If you look, what it's showing is the current fiduciary structure in a 401k. On the left side, I'll call them a rookie. That's the plan sponsor, aka the company, the business owner. And it's just kind of a cluster of how many things are going back to the plan sponsor. They're having to be responsible for reviewing, approving. It goes to the advisor, then the record keeper, the TPA. There's just so many things that April just touched on. Next slide. Again, the role of outsourcing the 316 really cleans that up. Now it's pretty clear what the advisor is doing on the right side. That rookie of the plan sponsor is now a relieved rookie, I'll say affectionately. You know exactly what the advisor is providing: oversight, advice, and education. Only responsibility, as you can see on the plan sponsor now, after outsourcing 316, is really just reporting payroll. And everyone has to report payroll, already does. They usually ask, are you reporting payroll? They say yes. They say, great. Now that's really all you need to do. And then it shows the roles outsourced with the 316 in conjunction with the roles that John can provide as well. Next slide.
These are a few statistics that I wanted to go over, and they're based on the data for 2019. Really not meant to be a scare tactic, but earlier Zach mentioned how the plan administrator, the employer, would be the person that the DOL contacts, right? Because you signed the 5,500. So if you, the employer, have more than 99 employees, you automatically have to go through an audit. And no one really wants to go through that. But if the DOL catches something and they question something, then you are the person that they're contacting. That is that 10,002 Form 5500s audited. That is the number of employers that were called from the DOL and said, hey, we have some questions. We need you to answer to this. I won't touch on all of them lightly here, but I just wanted to point out the 3,472 Department of Labor civil investigations that were closed. We have 75% resulted in payments, and that could be back payments, that could be earnings. It's whatever that the DOL has found. 255 cases referred for litigation by the Department of Labor, and at the very end, 8,860 ERISA lawsuits. Again, not meant to be a scare tactic, but really numbers speak volumes, and sometimes it's easier to really understand the importance if you can see what that plan administrator would be liable for. The next slide. So this is my top 10, and not necessarily a good top 10, but it's the top 10 IRS corrections. So when you are flagged, these are pretty much those items, the top ones that you'll get flagged for. I would like to start off with failure to amend for tax law changes. Well, what does that mean? That's your plan document, right? You need to make sure your plan document is always up to date and it's restated on time. Something as easy and as that can be handled by a 316 is listed as a correction here. And then you have loan errors. Well, what does that mean? Maybe loan payments were not remitted on time. Maybe they were and you don't have the right documents. Something so simple, a 316 can definitely handle. And then you have required minimum distributions. That is, if you are now 72.5 over with the new law. ADP, ACP failures not corrected timely, that is in terms of your testing. If every year your plan does need to go through testing, and so that's something that you would be liable for. And then number 10, exceeding maximum contributions amount. As Zach had mentioned earlier, there is an amount, certain amounts that you can defer into your plan. And so if you exceed that amount, refunds need to take place in a timely manner. Next slide. This is our conversion timeline. So what I want you to take from this, besides how fast we can actually implement a plan on our platform here, is that if you do decide to proceed with the 316, it doesn't affect the timeline. As a matter of fact, it becomes and makes the process more efficient because we step in right away. Really, it's an easy task. The 316 liability, taking that work off of you, items that you would have handled, we step in and take forth on that. Next slide.
Thank you. So this is just a piece from our actual service agreement, kind of nerdy stuff, but just talk is cheap, put it in writing, make it legally binding, not just a promise. Okay, we do. This speaks to when you are looking to outsource 316, just always ensure that the service provider, be it Pentegra, whoever the case may be, actually puts it in writing. As you can see, this is highlighted where it actually identifies that Pentegra would be in all governing documents to Department of Labor, Internal Revenue Service, et cetera, identified as a plan administrator in the plan document. Next slide. This is the recap. I'll kind of just fly through this as we're kind of going through. Next slide. We'll conclude on this slide here. Just want to, again, I think the source matters. Again, why is Pentegra talking? Why are Zach and April on here? This showcases where we come from. Pentegra is not a bank or an insurance company, not a mutual fund company. What that means, no other obligations other than serving our clients. As you can see, some of the things that Rob and John touched on, choosing from, there's so many mutual funds out there and being able to select with ESG. I will state here that Pentegra proudly offers a turnkey full fiduciary outsourcing program. And I'm proud to say I'm a creator of that program that incorporates the various aspects of the fiduciary outsourcing we touched on here. This program is designed to be a superior delivery vehicle for retirement plans that allows companies and their employees to align their sustainable values or green beliefs with investing conviction, specifically for the sustainable business community. I'm a true believer in ESG investing almost as much as my wife, who I don't think she will even eat in a restaurant if they use plastic straws, but she's a true believer. But I'm proud to say here at Pentegra, everything we just covered here, we've put into a turnkey, and I say turnkey, again, the full fiduciary outsourcing in tandem with folks like John, who take care of the investment side, our 316 offering. I appreciate everyone's time, and we'll conclude it there.
All right, thank you so much, everyone. I will stop sharing our screen now. We would like to get into questions, but before we do that, I do want to quickly launch a poll to hear from our attendees. So I'm going to go ahead and do that. There are a few questions on here. We'll take about a minute or two to answer these. And if you have any issues with viewing the poll, feel free to let us know in the chat box. Actually, while we're waiting on our attendees to vote, I think I will quickly get into questions now. I see that Rob had answered 2 questions in the Q&A box. If anyone has any questions, feel free to put them in the box now. All right, I actually, I have a question for John. And I believe John can take this, but if Zach would also like to weigh in. How and why is it important to work with an independent advisor who is a licensed fiduciary?
Hi. Well, I think it's important because it allows the business owner to realize there's no kind of hidden agenda. So the idea of working with an independent advisor, we don't have any proprietary, what are called mutual funds or investments. We're there to really help figure out what that business owner wants to have on that underlying investment or insurance product, and then provide that to them, kind of go out into the marketplace for them. And that fiduciary aspect of it literally does mean that we take an oath, we take it very seriously, that we need to act in our client's best interest at all times. And not all advisors are committed to that or can kind of say that. I am a certified financial planner, so that is part of our code of ethics as well. So hopefully that answers that question.
Thank you, John. I see in the chat, Lori, you have a question.
Yes. Thank you very much for this excellent educational seminar, much appreciated. And I want to just also say that we've worked with both Natixis and Social K at our business, the Longfellow Health Clubs, which has locations in 6 different places, and they've been very helpful. I just want to give a little shout out to those 2 folks, but it's been very educational. I appreciate it. But 2 really important questions for SBN and SBN members are, first of all, how can we get money in the hands of locally owned businesses and not just publicly held corporations? How can we do that? And is that possible through a 401k, for example? And the second question is equally important, which is that right now, SBN has made the center of our work around racial equity. And is there a way in which SBN and our friends, people on this call, can make racial equity a bigger part of how we screen when we do our ESG decisions? Because right now, I think it's a critical time for a lot of big companies and companies of all sizes to take a positive stand on working for racial equity. So that's 2 questions. I'd love to hear answers from whoever thinks they've got an answer to it.
I've got an answer to part 1. I've worked long and hard on that. And what happens is ERISA rules say that any investment in a 401k has to be liquid quarterly. So if you have local investments that are liquid quarterly, there's a way to go there. It's round and about, but if they're not liquid quarterly, that's what we kept coming up against. So the solution was to create a Boston or a New England sustainable local bond fund where you're loaning these companies money, they're paying interest, and then that bond fund is a publicly traded bond fund that you can buy shares in for your 401k and trade quarterly.
Well, it sounds like it's a project for you to join SBN with, Rob, so thanks for that offer.
Yeah, and then the other thing is, As You Sow has a lot of screens. They have an LBGT screen, they've got prison screens, the deforestation, the fossil fuels. I don't know that they have a racial injustice screen yet, but my guess is Andy Bihar is working hard on that, and that would be where it would come from if they're not already working on it.
Thank you, Rob. Anybody else have any answers to the question regarding racial justice and racial equity? Because that's the forefront of where a lot of people are right now in terms of trying to make some changes in something that's been going on way too long in terms of this systemic racism.
I would add to that, if that's okay. This is Bill Slimbaugh from Natixis. I would just say that there's been a lot of publicity lately around the Department of Labor in a recent proposal, Department of Labor to govern ESG investments inside ERISA-based plans. So I think what you'll find if you're looking at investments to sit inside 401k plans or any ERISA plan as you speak right now, it's critical that these plans take into account pecuniary interest and all that means pertaining to money. They have to be financial first. So if you're a plan sponsor and you've got an impact theme where you want to force rules on deforestation or Catholic values or Sharia, whatever the case is, yes, you should be able to do that, but the DOL is determining right now that you shouldn't be able to do that with your participants' money because they may not share the same views. So DOL is very clear on this. Investments held inside 401ks have to be financial first. So if you look at a social responsible fund, no guns, no tobacco, no booze, that may be deemed in violation of the DOL. The way we view ESG and the way ESG modern is implemented in the marketplace, we will pound the table all day long. The factors we're looking at are financial first and do help to reduce risk over time and increase performance. So you have to be very careful because ERISA rules are run by the DOL, and you do not want to run afoul of the DOL if you're in violation of those rules. So while your personal money can do what it should be, and that's admirable, you got to be very careful about how it's held inside ERISA plans.
I would just add one more quick point on that piece, just to build on that. I think we as ESG investors realize that diversity, equity, inclusion does have performance implications, meaning if you don't have a diverse board, diverse management team, diverse workforce, it doesn't represent your customers, right? That has performance implications. We definitely look at diversity, equity, inclusion, much more holistically than just the racial piece, but it's definitely coming more in the forefront as something that we need to consider. It gets a little bit difficult because there's not a lot of data on it. And if there really isn't data around some of it, then it's hard to manage too, especially if you're talking about a global portfolio and you're thinking about companies that are based in France, for example, where it's actually illegal for employers to ask those types of questions of their employees. So there's actually no reporting on it at the company level. So it's really difficult, but I think it's something that our industry is really focusing on and trying to sort of coalesce around. It's also something that we can engage with companies on, meaning as investors, right, we engage with the companies that we invest in. And if we spot areas of weakness, or if they have really poor policies and practices around some of this, we can have those conversations with company management and hopefully start to drive some change.
And I think to Bill and Clarice's point, Lori, we're talking about something called qualified assets, so retirement accounts. So non-qualified assets, individual business owners, regular investments, there could be a lot more opportunity that they have to make the impact outside of a retirement plan as well.
So I appreciate those answers, and I just want to put it out there that SBN views one of our roles is to push every industry in the country to be doing more things that are environmentally friendly, socially responsible, filled with racial equity. And I realize there's all these rules and regulations that get in the way of making that happen. But we feel that this time and this place, there's an opportunity here for our country to take a stand to eliminate some of the systemic racism that's been going on for a long time. And we want to push the envelope. And I think people on this call do want to do that. But I just want to encourage us to see that the barriers that are in the way of making that happen and finding ways to get around those barriers, because we've got a lot of work to do to make amends for all the damage that we've done to people of color over the years, particularly Black Americans. So that's my little soapbox speech. Thanks for listening.
You're one there.
Thank you. Thank you all. I'm going to wrap up with one more question here. What are some SRI ESG themes you see more prominent after COVID-19?
There's a few probably. I think we have to think about some of the long-term trends that have been accelerated, whether that's technology related, but internally in terms of, a workforce related considerations, we look at how companies are managing the transition to working remotely and online, how they're handling that with their employees in terms of, if they kept employees on, how they're continuing to compensate employees. We think about things like supply chain management, how companies are working with suppliers through all of this. Outside of that, healthcare is obviously a big focus in terms of one of the long-term trends that we would want to gain exposure to. We think there's going to be a lot more investment in that area as a result of this.
Thank you, Clarice. All right, I think we're going to wrap up here. Any last comments from our panelists?
Thanks for joining.
Thank you.
Thank you so much. We are going to follow up with the panelists' contact information. I might also put that, I'll share my screen and put that on the screen again for anyone who would like it right now. And thank you again, everyone, for attending. Thank you so much to our panelists for their helpful advice and guidance for small business owners during this time. We really appreciate you being here as a resource and for your time on this webinar. We do have some results from the poll. We did have more folks filling out the Google poll, so perhaps we can share these results, and that can potentially guide our conversation for the afternoon session. We will be on again at 2 p.m. So thank you very much all, and take care.
Thank you very much.
Thank you.
Thank you.